If you want to save huge amounts of money by securing the lowest possible interest rate for your next loan, then you need to have a credit score above 800. Today, I'm showing you how to get there. Hello and welcome to Practical Personal Finance. My name is Andrew Shear, and on this channel, I'll give you the information you need to help you understand and succeed with money. Today, I'm going to be talking about credit scores, specifically FICO scores. I'll tell you about the 5 factors that are used in calculating your FICO score, how much of an impact each of them has, and how you can achieve a credit score of 800 or more. If you're new here, don't be shy. Hit that subscribe button and join the conversation in the comments below. When you apply for a mortgage, car loan, or credit card, one of the first things the lender will do is take a look at your credit score. The higher your credit score, the more likely your application will be approved with the lowest interest rate possible. If you like low interest rates, give this video a thumbs up. When you have a high credit score, the lender can safely assume that you repay your debts in the agreed upon time frame. On the other hand, if you have a low credit score and can manage to get approved for a loan at all, it will probably come with a very high interest rate, costing you lots of money as you pay it back. If you're interested in just how much interest it'll cost you, I made a video about how to calculate interest on a loan, and I'll leave a link in the description. Alright, back to credit scores. Most lenders, especially for mortgages, will look at your FICO score when processing your application. If you're not familiar with what a FICO score is, it's just one of the several different types of credit scores out there. In this video, I'm going to focus specifically on FICO scores, but the principles will apply to all credit scores. There are 5 main factors that go into calculating your FICO score. They are your payment history, amounts owed, length of credit history, credit mix, and new credit. Let's break these down one at a time so you can have a better understanding of how to win in each category. First up is payment history. At 35%, this one makes up over 1/3 of your credit score, so you don't want to mess it up. When thinking about payment history, the underlying intention is to prove that you're a reliable borrower who repays your debts on time. If you were a lender, you'd rather let someone borrow your money if you knew they had a good record of paying it back on time, right? So what goes into your payment history? 2 main things: your record of making payments on time and in full, and the number of debts that you're currently paying. FICO tells us that you can still achieve a good credit score even with a payment that's just a few days late or a small account that's in collections. But this isn't a video about how to get a good credit score. If you want that 800 credit score, you need to have no records of late or missed payments on your credit report. If you have a late or missed payment, you can ask your lender very nicely to remove it from your report, and you might get lucky. But chances are you'll need to wait as long as 7 years for that late payment to go away. Besides making every payment on time, it helps to have several different accounts open that you're making payments on. Think of it this way: someone making every payment on time on one account for the last 7 years is a pretty reliable borrower. Someone making every payment on time on 5 accounts for the last 7 years is an extremely reliable borrower, greatly deserving of a higher credit score. The second factor is amounts owed. This makes up 30% of your FICO score. When thinking about amounts owed, the thought process is that if you owe a lot of money on a lot of different accounts, you're at greater risk of being overextended than if you owe a smaller amount of money. From a lender's perspective, all things equal, would you prefer to lend money to someone whose monthly payments are $5,000 or just $500? If your borrower lost some of their income, there's a better chance of you still getting paid if they aren't so deeply in debt. The amounts owed factor is a little bit more complex than payment history. There are 3 main things that you need to pay attention to. First is the total amount of debt you're carrying. It's better to be carrying a smaller amount of debt than an extremely large amount of debt. Second is your revolving utilization on credit cards. It's best to use between 1 and 10% of your maximums every month on your credit cards. If you have credit card accounts open but don't use them, they're not really helping you build your credit score. If you max out your credit cards every month, there's a higher chance of you missing a payment if you have a crisis. Third is what percentage of each of your installment loans has been paid. If you have an installment loan on a car, for example, it helps if you've paid a significant portion of the original loan balance by making consistent payments over a long period of time. It's better to have 80% of the balance paid off than if you're just starting out with a loan and only have 5% of it paid so far. Here's the bottom line when it comes to amounts owed. If you want that 800 credit score, you want to carry some debt, but certainly less than the maximum you're offered. Your credit card utilization should be under 10%, and you should probably only get at most one new installment loan per year. Together, your payment history and amounts owed account for about 2/3 of what goes into calculating your FICO score. If you have limited bandwidth, then these two are the ones you need to be paying attention to. But to get that elusive 800 credit score, there are 3 more pieces to the puzzle. Factor number 3 is length of credit history, and it accounts for about 15% of your FICO score. This is one of the more straightforward categories, and it's very easy to understand. If you're a relatively new borrower with newer accounts that haven't been open for that long, statistically you're a less reliable borrower than someone who has a long credit history. Think of it from a lender's perspective. All things equal, would you rather loan money to a 22-year-old who got his first credit card a year ago, or a 52-year-old who's had a credit card for 30 years? Obviously, the 52-year-old is a better bet to pay back his debts in this case. When looking at the length of your credit history, FICO is primarily looking at the average age of your accounts. If you have 2 accounts on your credit report, one of which is 2 years old and one of which is 6 years old, the average age will be 4 years old. Length of credit history can take a long time to build. If you're just starting out, look into becoming an authorized user on an older family member's credit card. Even if you don't use their card at all, the account will still show in your credit report and impact the average age of your accounts. If you have a credit card that's been open for a long time, try to avoid closing that account. This will almost certainly have an impact on your length of credit history. You might be able to get an 800 credit score without a very long credit history, but to make your life easier, you'll want the average age of your accounts to be over 10 years. Factor 4 is credit mix. Again, this one is fairly straightforward. It accounts for 10% of your FICO score. Lenders consider it a positive if you have several different types of credit included in your credit report. There are 2 main types of credit you can have: revolving credit and installment loans. Revolving credit includes things like a traditional credit card, a card from a retail store, and a home equity line of credit. Installment loans include mortgages, car loans, and student loans. If you want that 800 credit score, it helps to have a couple of revolving credit accounts and a couple of installment loans. The final factor is new credit. It's worth the final 10% of your FICO score. New credit generally has to do with how many inquiries are on your credit report. When you apply for a new credit card or loan, the lender will pull a copy of your credit report from one of the 3 credit bureaus. This is an inquiry. Inquiries stay on your credit report for 2 years, but FICO only considers the past 12 months when calculating your FICO score. If you have a bunch of inquiries on your credit report in a short time span, it's likely that you're in financial trouble or you're taking on a lot of new payments. To a lender, this is risky behavior. If things go south, you could end up declaring bankruptcy, which they want nothing to do with. Opening new accounts can have a double negative effect, as it will count as an inquiry on your credit report, and it will also reduce the average age of your accounts. New credit is not all bad though. It can also have a positive effect if the new account you're opening adds to your credit mix. If you're going for 800, I would generally recommend avoiding new credit when you can. At most, I would open 1 new account per year. Here's the bottom line. Getting an 800 credit score isn't necessarily difficult, but it doesn't happen overnight. It's not necessarily even something that happens over the course of several months. Usually it takes several years to achieve. The best way to get there is to make a plan now for how you'll follow each of the recommendations I made throughout this video, and stick to it over that long period of time. Check in on your score every 2 or 3 months to see how you're doing, and make sure you're headed in the right direction. Have you ever achieved a credit score of 800 or higher? Let me know in the comments. If you enjoyed this video, give it a thumbs up. And please consider supporting my channel by becoming a subscriber with notifications turned on. Thanks for watching. I'm Andrew Scheer, and I'll see you next time.